Welcome to Principles of Macroeconomics. Lecture 4 will study supply, demand, and some basic applications and extensions.
First, we need to take a look at resource and product markets. Resource market refers to the market for inputs used to produce goods and services. The product market, on the other hand, refers to the market for finished goods and services sold to final end users. Firms and producers purchase factors of production such as labor and intermediate goods from the resource markets and transform them into final goods through productive activities in the production process. Due to producer participation in both markets, there is a strong connection between these two markets. Price movements in the resource market can affect prices in the final product market. For example, if we have an increase in the wage rate, also known as the price of labor, this will increase the cost of production of automobiles. This will also lead to a reduction in the supply of cars and therefore increase the equilibrium price in the automobile market.
Conversely, when demand changes in a product market, the demand for and prices of the resources used will change in the same direction. This is a result of a change in producer demand for inputs into the production process. For example, an increase in demand for automobiles will increase the equilibrium quantity of cars bought and sold, so producers will increase demand for labor and materials, resulting in higher prices for these inputs. Next, we will take a look at price controls and efficiency losses. Price controls are government-mandated prices imposed in the form of maximum and minimum prices. They come in two main forms. First, we can have a price ceiling, which is a legally established maximum price that sellers can charge, or we can have a price floor, which is a legal minimum price that buyers must pay for a good. Effective price controls mean that the government policy has an influence on prices charged in a market. Now we will see how each policy influences market dynamics. Now we will take a look at a price ceiling or a legal maximum price. Government officials and interest groups claim that price ceilings can benefit the consumer by providing a good at a lower price. Although these policies have good intentions, they are ultimately costly to both buyers and sellers. Price ceilings result in a shortage as the quantity demanded exceeds the quantity producers are willing to supply in the market. Now, if we take a look at the diagram below, we can see that the equilibrium price in this market would be at PE and the equilibrium quantity would be at Q2. However, with the price ceiling imposed, the quantity demanded in this market increases to Q4, but the quantity supplied decreases to Q1. The difference between Q4 and Q1 is a shortage that we have as a result of the maximum price. The other type of price control we can have is known as a price floor. Governments use price floors to establish a minimum price that buyers must pay for a good or service. For example, the minimum wage is one example of a price floor in the labor market. Buyers, which are generally firms, must pay a minimum wage rate for each hour of labor that they purchase. In contrast to a price ceiling, price floor results in a surplus of the commodity being traded. In the labor market, more labor is supplied than the quantity demanded by firms, and this ultimately results in unemployment. Now we will take a look at the effects of taxation. The tax rate is the per unit amount of the tax, or the percentage rate at which the economic activity is taxed. Taxes, or newly imposed taxes rather, cause shifts in supply or demand, and ultimately lead to market inefficiency by reducing the quantity traded in the market. The economic effects are identical, regardless of whether or not the taxes are placed on the buyer and seller. Let's use a graphical example of a tax that is legally imposed on the seller. Now, this tax shifts the supply curve up by exactly the amount of the tax, but it really doesn't matter if we place the tax on the supplier or the demander. The incidence of the tax or the tax burden that falls on each party, is largely determined by the elasticities of demand and supply. In this case, the tax burden is split between buyers and sellers in equal amounts. The quantity of the goods traded in the market are reduced from 460 units to 400 units. The price that consumers have to pay increases from $260 a unit to $300. However, the amount that the seller actually receives for each unit is $220, as the amount of the tax is $80. So in this case, some of the tax is absorbed by the seller, who will ultimately take a lower dollar amount per unit sold, but the buyer also has to pay $40 more than they would have paid before. The blue triangle in this diagram is called the deadweight loss. This is a loss of gains from trade or economic efficiency that results from the tax. Now we will take a look at the incidence of a tax. The burden of a tax depends on the elasticities of supply and demand. The economic incidence of taxation refers to the split of the tax between two parties, buyers and sellers. So, who pays the most in tax revenue? The side of the market with the relatively higher elasticity will have a lower tax incidence. So, when demand is relatively inelastic, where the demand curve is more vertical rather than horizontally shaped, or supply is relatively elastic, buyers will bear the larger share of the tax burden. Conversely, when demand is relatively elastic or supply is relatively inelastic, sellers will tend to bear the larger share of the tax burden. One way to think about this is the party with the more inelastic curve is least able to avoid the tax. However, the sellers or the buyers with more elastic properties will be able to substitute away from the good and avoid the tax. So, how do we measure taxes? There are two main ways. One is called the average tax rate. This method takes the total tax liability, or the amount of taxes owed, and divides them by total taxable income. However, the more relevant way to measure taxes is called the marginal tax rate. This measures the change in tax liability divided by the change in taxable income, or the additional income that you earn. The marginal tax rate is the most relevant for economic decision-making, as it influences the additional benefit a person receives from earning another dollar in income. For example, a marginal tax rate of 10% means that if a person earns $1 more, then they must pay an additional 10 cents in taxes. So, when analyzing taxation, can we have too much of a bad thing? Well, when tax rates are already high, a rate reduction may actually increase tax revenues. Correspondingly, increasing high tax rates may lead to less tax revenue. This is because, as taxes increase, we tend to reduce the incentive to engage in economic activity. This reduces the amount of activity subject to taxation. In other words, we end up reducing the tax base. The diagram in the lower right-hand corner of the screen shows the Laffer curve, and this shows the relationship between the marginal tax rate and the tax revenue that a government is able to collect. Obviously, with a tax rate of 0, there won't be any tax revenue collected by the government. But as we increase the tax rate, slowly the government will be able to increase that tax revenue. However, beyond a certain point M, the incentive for productive activity, that is starting new businesses or earning additional income, is largely reduced. And with a tax rate of 100%, there's no incentive for people to earn additional income. Now we will take a look at the impact of a subsidy. Subsidies are government payments to buyers or sellers when a good or service is purchased or sold. In the market below, we see that supply actually increases as a result of a subsidy given to producers. This is because suppliers are willing to provide more output at each price due to government payments. Also, another way that you can think about this is that the minimum price required to induce a seller to produce each additional unit is now lower because producers can use government payments to cover more of their production costs. Actually, what happens is production costs stay the same, but they appear lower to the seller who receives this added government subsidy. The impact of the subsidy on this market is that prices are reduced from P1 to P2. However, the quantity traded in the market increases from Q1 to Q2. Now, although this may appear beneficial for consumers and suppliers, we have to remember that this places a tax burden on some other market because the funds for the subsidies have to be gathered from taxation in some other area of the economy.